Yo, what's up, everybody? It is Wednesday, November 30th. That's it, the end of the month. One more month left in 2022. All right, we had a big day today. Big day. You know, folks, this week on Monday, when I sent out my report to my subscribers, the headline of my report was that the monetarist cohort is going to have to start changing their view. You know, all these monetarists who've been so bearish because of rate hikes, they're going to have to start, changing their view. And if they're short the market or out, they're going to have to start covering those shorts or getting back into the market. And today, and I didn't expect this to happen so soon, but it looks like the monetarists are starting to change their view based on today's comments by Jerome Powell, who basically kind of gave the word that the Fed was going to slow down its rate hikes. And he didn't say they were going to stop the rate hikes, but what he communicated, or at least what was heard by the monetarist cohort, is that the Fed is going to slow down. Now, I checked the Fed fund futures, and futures are still predicting a 50 basis point rate hike in the December meeting. And it's like a 50-50 now probability for either a 25 basis point rate hike in February 2023 or a 50 basis point. So that changed a little bit, but not much. So, I think the whole thing just shows you how ridiculous the monetarist view is. There's been very little change in the expectation in the market itself, but suddenly, because Powell utters a few words, then they're triggered. Hang on. New York City. So they get triggered. Now, it's one thing if, back in March when the Fed was about to begin the rate hikes, it's one thing if, you moved to cash at that time or you went short. Because I told you, it's like two curves. It's like the rate hikes initially have more of an immediate negative impact, okay? Because you have that discounting of, future value, of the net present value gets discounted because the variables in that equation, like I said yesterday, are interest rates and cash flow, okay? So the cash flow remains unchanged. And by the way, in the first half of this year, the cash flow was lousy because we were going from a 10% GDP growth rate in the fourth quarter of 2021 to negative, in the first and second quarter of this year. Not because of the rate hikes. We were going negative because of the historic contraction in fiscal support. I've been all over this. I've spoken about this and I've explained it so many times. You had almost $2 trillion drained out of the non-government's financial balances. Again, the swimming pool analogy, that just sucked the water way down, all the way to the bottom. And it needed time to build back up again, which is what's been happening in the second half of the year. So anyway, I can understand if you went short or if you went to cash in March or even in April or May when the Fed was really starting to get going on the rate hikes, because the initial impact is negative from that discounting effect of higher rates. But then, you reach that inflection point where the impact, and it's not just recently I've been saying this. I've been telling you guys that we're going to reach an inflection point where the negative impact of the rate hikes will diminish and the positive impact of the fiscal side of those rate hikes, in other words, the interest income transfers into the economy, that's going to be increasing, and then you're going to have those two lines they're going to cross where, you know, the negative from the rate hikes and then the positive from the fiscal, and then the positive fiscal takes over. You know, one of the reasons, like, I don't like basically moving, you know, it's not that I don't play the short side. I mean, sometimes I do. I did it in 2020 with the pandemic for a short period of time, and I caught that really, really well. I mean, I basically don't like doing it because in a fiscal environment where the government is spending like 7 trillion, okay, and where the net spending, we're talking about, you know, deficits exceeding $1 trillion. I mean, that's like going against a tsunami. All right, I mean, we're kind of like in a new paradigm right now because, you know, pre-pandemic, or I should say even pre-Trump, if the deficit was 400 billion, that was like, oh my God, 400 billion. You know, now we're routinely talking about trillion or multi-trillion annual deficits. I mean, that's like, you know, that's water flowing into the swimming pool at a very rapid and voluminous rate. So, like, you know, you can go against that for short periods of time, but I just, you know, like, you got to be so adept at that. To me, it's like I'd rather allow that to happen and add to my portfolio as the market comes down, because I know that, you know, we're in this environment where the swimming pool is going to fill back up again. And I've been telling you guys, like, load the boat now, because 2023, like, I'm saying this to you again. 2023, first of all, we're just seeing the very initial beginnings of those interest income flows into the economy, okay? I've been, you know, like, I cite these numbers in these videos almost every day. You know, you got 30 billion, we're not even 2 months, let's call it, we're 2 months into the fiscal year, right? October, November. You got 30 billion in the discount on new issues like T-bills and other government issues. 30 billion just from that in 2 months. You got, you know, what, 11 billion on interest on Treasury securities, and that's just it's at the infinitesimally small beginnings. I mean, that's going to ramp up, like, and it's going to stay ramped up for years now, because, you know, as they issue new 2-year, 5-year, 10-year, 20-year, 30-year, they're all going to have that higher coupon, and then that interest is going to get paid for the duration. Okay? I mean, this is what I've been through this like almost every day. I talked about that guy Bullard the other day. Like, he can't even do some basic arithmetic that, you know, he wants a 7% Fed funds rate. You're talking about, you know, almost 2 trillion annually addition on top of the 7 trillion that the government already spends. 6 trillion, let's call it 6 trillion now. So you're talking 8, maybe 9, maybe even 10 trillion in spending. Like, who goes short? I mean, going short in that environment, I mean, you can. I'm not saying don't. I don't tell you what to do. I advise, I recommend, I say what I do. I mean, I just, like, you know, that's like, you know, those planes, sometimes you've seen these planes where they build the wings swept forward, not swept back, and it's like, how does that thing fly? It goes against all principles of aerodynamics. Well, those planes, they need, like, you know, these computers that have to do like hundreds of thousands of calculations a second just to keep that thing in the air. I mean, it's a lot easier just to build the plane in an aerodynamic, you know, structurally aerodynamic, like with the wings swept back and the right shape of the wings. But, you know, it doesn't mean you can't do it. It doesn't mean you can't go short. But, and, you know, I don't know, some of you may recall, if you've been with me long enough, like I told you the story of my days as a floor trader. You know, I spent many years on 4 different exchanges. And for some reason, like, the independent traders in those pits, myself included, like we always wanted to sell the market. We always wanted to go short. I have no explanation for that. It was weird. It was kind of like this, collective psychology that the locals, as we would call the independent traders, we always wanted to sell. And the biggest guys in the pits, the ones I remember anyway, the most profitable, the real, like the real cowboys who push things around, they were the buyers. And, there was maybe like one or two of them, we'd be standing in a pit, didn't matter what, it could be crude. I was in crude, I was in gold, I was in the S&Ps, and be like one guy who was the buyer, and he was huge, and everybody else, all of us were always like the first down ticket, like sold, we want to sell that thing down. I don't know why. That was just like, so like that sticks in my head too from my days as a floor trader. Like it just was not a good strategy. It was not a good strategy. I mean, and the reason why it was not a good strategy is nothing has changed really in that period of time. Like I'm talking about, we're going all the way back into the early 80s when I started on the floor. And it's like, you got that fiscal flow, and it's just like every year that's filling up the swimming pool. And like, you could argue against that as much as you want. And you could say all these cockamamie things like, oh, the debt is going to blow up one day and it's debt doomsday, and people have been saying this for decades, right? But they don't understand. That's just like adding financial assets to the balances of the non-government. Adding financial assets. I mean, it's wealth. It's financial wealth. It may not be wealth in real terms. In other words, we still have crumbling infrastructure. We have very little modern manufacturing capacity. We we outsource all that. But I've said in the past, like if you think of the world economy as a closed system, which basically it is up until the war in Ukraine, I guess you could argue that now because of the war, it's fracturing into blocks. Okay, you got U.S. and Europe, and then you get the, you have like the BRICS, you have Russia, China, India, Brazil, those countries that are creating like a kind of a southern, bloc. And we'll see how that plays out. That too is just in its early stages. But anyway, I'm getting off track here. So, so the monetarists are changing their view, and this is just the beginning. Like I saw this guy. I mean, some of them are still predicting a very severe recession in 2023. In 2023, as I was just about to say, we're still going to have these interest income flows ramping up. Okay, that's going to persist for a long time, as I just explained. We're going to have a big historic increase in Social Security benefits because of the cost of living adjustment. I mean, that's coming in 2023, all right? Because we're in the Cold War too, defense is going to get boosted again. So, I mean, you're not going to see any kind of a pullback or a contraction in the fiscal. I just don't see it. I mean, I see 2023 as like a boom year, man. And I've been telling you, like now, December, we could still get a pullback in the market in December because mid-December you get another quarterly corporate tax payment. That's going to be a drain. So you'll get some weakness that you could buy into, but then, you got to load the boat. You got to load the boat and then go play golf for a year next year. So that's what's happening there. Now, let me say something a little bit about oil today, because we had the EIA weekly petroleum status report. Crude inventories down 12.6 million barrels. That was almost the biggest drop in 4 years. That was the biggest drop in 42 months. Okay? Gasoline and distillate built up, and I would say gasoline right now is about equal to last year. Inventories and distillates still down, but that gap is narrowing, all right? Demand, product demand, gasoline demand, and distillate demand was fairly soft, I should say, domestically, all right? Refiner inputs of crude, that was strong. It's been up for the last 5 weeks, and I think it's like at a 6-month high right now. Here's the thing, though. Exports just surged right up, okay? We had a export, get this, man, because Biden's saying, hey, he's bashing the oil companies for not producing more. I mean, it's all getting exported. Like, we did 11.8 million barrels of crude and product exported in the week ending last week. What was it? November 25th. That's a record, 11.8 million. And net, we did net almost 3.9 million. That means we net exported, when you take exports minus imports, we net exported almost 4 million barrels of crude and refined products. I mean, if you want to understand, like, even if the oil companies boost output, it's all going to get exported because they're already doing that. The demand is it's just not here domestically. They're sending it, and you could see this all happen when the sanctions on Russia were applied, when the war started. I mean, basically, you could see the strategy here. I don't know if it's intentional. It could very well be that the whole reason behind the real reason, I should say, behind the sanctions was to position U.S. oil companies as the main supplier of petroleum to Europe at high prices. And you could say what you want about that, but me, I am heavily invested in oil stocks, and I've been. So, yeah, does it suck to pay higher prices at the pump or wherever? Absolutely. But like I always say, if you're smart, you can protect yourself, or at least, offset it a little bit. I mean, use information to your advantage, no? If you don't, I mean, that's on you. Sorry, that's on you. And there's only so much I could empathize with somebody who just is complaining, but has a path to at least, give themselves some protection. If you don't take it, that's on you. So exports, I mean, that's huge. And by the way, that is a strong underpinning for the dollar, for the bull case for the dollar. Now, I happen to think short term, because over the next few days, we got some big positive fiscal flows. Between tomorrow is the first of the month, so that's the big first of the month's payments day, 100 billion. And then Friday's a Social Security day, so that's another 25, 30 billion. These are probably short term, and the dollar dipped a little bit today. But after that, I think the dollar's bull trend through the rest of December is going to resume. I don't know if it's going to hit new highs. I'm talking let's say the dollar index or whatever, but I think the bull trend will resume because, I mean, U.S. Exports of petroleum, that is a major bullish underpinning for the dollar. All right, that's the update for today, folks. Everybody, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. I'll see you tomorrow. Bye.